Well, in recent weeks, market sentiment has been lurching from one extreme to another, depending on the news emanating from the debt crisis in Europe and America. It seems the Europeans are now getting their house in order at last, with France and Germany agreeing to a Greek bailout. But in the US, politicians continue to argue over how to cut the nation's budget deficit. And America's deadline is now just days away, with the debt ceiling due to be hit on the 2nd of August. For his take, I spoke to Hamish Douglass from Magellan Financial Group on Friday. Well, Hamish, will the Greek bailout package agreed in Brussels this week prevent a major contagion?
Well, Alan, that is difficult to answer definitively. This has been a very fast-moving event. The announcements overnight in terms of a new bailout package for Greece, in our view, has been a major step forward. It is the first package that actually is aimed at addressing a solvency issue in Greece. And in our view, the package has a number of very encouraging developments in it. The package to extend the loan term of the loans provided by the EU and the IMF from 8 to 15 years and to reduce the interest rate to sort of 3.25% is what they're proposing, will have a major benefit for Greece in terms of a lower net present value of the debt that they owe the EU and the IMF. But other parts of the package are also appearing encouraging also. The banks could either exchange loans as we currently understand it, and this is still being worked out, for either 30-year bonds or 8-year bonds at 4% interest rates. This would have the effect of writing down or relieving Greece a burden of maybe 20% of the value of those bonds held by the financial systems. Is it enough to fully address the solvency issue in Greece? Could we be back in 12 months still not fully address this issue? Look, I think there's still some water to go under the bridge, Alan.
But the solution's been staring him in the face all along, hasn't it? I mean, the European Financial Stability Fund was always going to be the answer, and the maturities had to be lengthened and the interest rates had to be cut. I mean, why did it have to take so long?
Well, I think initially last April when this first really came up, they first of all had to just plug a liquidity problem immediately, and I don't think people had really had enough time to think through solutions, and then it took on a very ugly political turn between the politicians, the finance ministers obviously having very divergent views, and the central bank having very divergent views about what a solution could be, and an almost denial that there was a solvency problem in Greece and this was really a liquidity problem. I think what we're seeing now is an admission there is a solvency problem, and unless they relieve Greece of some of its burden, this problem cannot be solved, and I think that's why this was a very positive step in the right direction.
Yes, and although this week's package was all about Greece, isn't it fair to say that the real focus behind that is Italy and Spain and the need to prevent any kind of financial market panic about them and therefore a liquidity crisis for them?
Look, at the end of the day, again, you have to split Europe between where are the solvency issues and where are liquidity issues. Greece, there clearly is a solvency issue. There are potentially solvency issues in Portugal and Ireland, and they're getting some of the benefit of these packages that have been announced overnight with extension of terms and lower interest rates. That may address their solvency issues. In Spain and Italy, we don't think there are really solvency issues. The risk for those countries is the bond markets through fear go on strike or push their bond yields up so far that a liquidity issue then becomes a solvency issue. Our view is that provided they address the real solvency issues and address it fundamentally, particularly starting in Greece, the markets will then relax and realise that Italy and Spain don't actually have solvency issues, and their bond rates should settle in rates that are appropriate for the level of debt that those economies have and their other economic issues.
There is a suggestion that this week's package will bring about a selective default by Greece. Do you understand what a selective default means and what the consequences of it would be?
Yeah, I think we do understand what it means. I think any bonds that are subject to exchange effectively are not getting repaid on the terms that they were issued. And by that definition, I think the rating agencies will judge them as selectively defaulted, and technically the central bank could stop accepting them as collateral because they're now technically defaulted, and also they may trigger an event under a credit default swap where credit default swaps may have to be settled. But as soon as those bonds are exchanged for a new bond, that new bond will no longer be defaulted. So it's selective. So it's not like the whole of Greece defaults, it's only the bonds that's subject to exchange on different terms from their issue would be in default. And when they're exchanged, the new bonds are no longer in default. And that's why it's selective. So I think it's pretty clever what's been thought through. There's been a lot of thinking around this, and we are pretty hopeful that if it goes through this package and bonds are exchanged, you are not going to see a financial calamity around the world because of the selective nature of the default.
The other thing hanging over the markets, of course, is the US debt ceiling. No deal yet there. Does that also have the potential to bring about a financial calamity? Yes,
Alan, it does hold the potential for a financial calamity. You know, every degree of logic in my mind would tell me that the risk of the debt ceiling not being lifted prior to August 2nd is very low, but we're dealing in a very difficult political environment in the United States, and therefore the risk as every day goes past has to increase, given we haven't had a solution. It is very difficult to actually know what would happen if the United States did default for a short period of time. There is a potential, given so much sovereign debt is held in money market funds and is used as collateral to finance the financial system in the United States, if because of a technical default in the United States that collateral wasn't accepted or people panicked in the money market funds, you could have a very, very severe event. I don't know whether it would happen or not, and therefore it'd be crazy to run the gauntlet of allowing a default. Again, we still think it's low probability because the outcome is so unknown if it happened. I don't think it would last very long. I don't think there's any real risk that the US cannot fund itself going forward, but there's a very technical issue coming up, and I just don't know what the outcome is going to be, although, as I said, every bone in my body tells me it'd be so illogical to run that risk if you're a politician or a regulator in the United States.
Well, if you think that the European debt deal is a good one and it'll settle things down there, and every bone in your body says that the US debt ceiling will be increased, doesn't that mean, therefore, that you must be a big buyer in the financial markets?
Look, we're sitting at the moment in a bit over 3% cash, and we have in the past, because of events like this, been up to 30% cash. So we are relatively relaxed at the moment that these are low probability events. I'm talking about the calamity events, where you could get an uncontrolled default in Europe. That looks much lower risk today than it looked even a few days ago, although we thought that was a pretty low risk event. In the United States, we think it's low risk, but that doesn't mean it can't happen. We're still pretty defensive in our portfolios of where we are. And if it does happen, we would hope it would last for a very short period of time. But we could have volatile equity markets still for the next few weeks, particularly now centred around the United States, as Europe seems to have made a big step forward.
It's been great talking to you, Hamish. Thanks for joining us.
A pleasure, Alan.